My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to save you some money. My job is not just to entertain you, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Every night I come out here for two big reasons. The first is obviously I like the attention. But the second and more important reason is that I want to help you build and preserve your wealth. We live in a world where it's increasingly difficult to become rich if you weren't born that way. And love it or hate it, I believe that the stock market is the best ladder we have in this country for social mobility. There are millions upon millions of people in this country, but there simply aren't that many jobs that pay you a salary fat enough to actually make you rich, even if you're a total cheapskate and save nearly every single penny you earn. The truth is, if you want to become really wealthy in this country, unless you're born with a silver spoon in your mouth, that means planning your financial strategy for an entire lifetime. Even if you don't have a super high-paying job, as long as you can save a decent chunk of your paycheck and then invest it wisely year after year, you can make your wealth grow to the point where you become, if not filthy rich, then at least, the very least, financially independent. Meaning you don't need to worry about your job security or where your next paycheck is going to come from. And you'll be able to retire easily without the need to rely on Social Security, which, for all we know, might not even be around when some of our younger viewers hit retirement age. That's why tonight I want to help you figure out the best way to manage your money in order to help achieve real financial independence.
House of pleasure.
But in order to do that, we need to talk about the concept of generational investing, because the kind of strategies that make sense when you're young and in your 20s are very different from the sort of things you should be doing when you're middle-aged or a senior citizen, for that matter. We don't talk enough about that on Mad Money. Tonight's different. But there's one constant when it comes to managing your finances, no matter how old you are, and that's the fact that you will never get a better opportunity to make your money work for you than by investing in the stock market. Even when we're in a bear market, when the action is treacherous and volatile and it feels like stocks go down every single day, when you take a long-term view, it's easy to see that the stock market is by far the most effective method of wealth creation out there. Sure, it might go down for weeks, for months. It might go down for years. It might crash like it does upon occasion. But if you take the long view, the very long view, stocks tend to go higher. And I don't say that as some sort of Pollyanna. When I got started in the business in the early 1980s, the Dow Jones Industrial Average was trading in the 800s. And despite multiple bear markets between then and now, the Dow currently stands what you might call well above that mark, right? That represents a pretty fantastic amount of wealth creation. And that's why I'm so adamant that no matter how old you are, no matter how wealthy you are, you really should have some of your money socked away in the stock market. And for those of you who are concerned that the market's rigged, that it's dangerous, that it's simply too unreliable or unsafe a place to trust your savings, can I give you some historical perspective right now? If you go all the way back to 1928, that's right, before the great stock market crash that preceded the Great Depression, through the end of 2014, the average annual return for the S&P 500, including dividends, is about 10%. Show me an asset class with a better average return. You can't do it. Stocks aren't just the best game in town. They're the only game in town if your goal is to grow your wealth. Now, for some of you who want to get rich quick rather than get rich carefully, see what I did there? That 10% average annual return for the S&P 500, I know, it may not seem like such an impressive number. Some of you are probably saying, well, thanks for nothing. Wait a second, you're wrong. You're just wrong. Forget the fact that it's more than double what you can even expect from a 30-year treasury. Or it's certificates of deposit. I mean, they earn you next to nothing. Let's examine that 10% figure in absolute terms. When you're taking a long-term view, which is what we're doing tonight, meaning planning for your entire lifetime, racking up a 10% return from a simple, inexpensive S&P 500 index fund, which you know I prefer, starts to seem pretty darn impressive. Sure, the market's going to have its up years and its down years, but over a long enough time frame, that 10% figure, including dividends, has held pretty steady. But to really understand the value of an asset class that tends to give you a 10% return in the average year, You need to view this number through the lens of what's known as compound interest. Sometimes I'll talk about this as the magic of compounding. Think of it like this. If you invest $100 in the S&P 500 and it gains 10% in the first year, then you've got $110. After another year of 10% gains, you've got $121. A third year of the same gives you $133. The gains keep getting larger and larger because each year you're making additional money off the previous year's profits. Eventually, with a 10% average return, you'll double your money in roughly 7 years. Now, for those of you who are really young, right out of college, waiting 7 years to double your money, I know, it seems like an eternity. And listen, I've got more risky ways of growing your capital faster if you stay tuned. However, the truth is that as you get older, an investment that can pretty consistently, take your money up in 7 years' time and double it, well, I'll tell you, it just becomes pretty incredible. That said, the magic of compounding works best the younger you are, because that means you have more time for your money to grow. Yet, sadly, young people are the least likely to be impressed by that kind of steady capital appreciation. That's why acclaimed economist George Bernard Shaw famously said that youth is wasted on the young. Okay, he wasn't an economist, he's a good writer, though. So let me do my best to make these numbers sound more impressive. I'm going to walk you through it. Suppose you're 22 years old and you're just entering the workforce. You've got more than 40 years before you're expected to retire. So let's say you invest $10,000 in an S&P 500 index fund right now. And let's also suppose that the next 40 years aren't too different from the last 40 years. In that case, if the average return from the S&P 500 holds steady at around 10%, then in 4 decades, your $10,000 investment will turn out to be worth more than $450,000. That's enough to send multiple children through college, grad school, buy a nice house in most parts of the country, pay for a huge chunk of a pretty ritzy retirement. And that monster multi-year gain, it didn't require any kind of stock picking. It doesn't require you to trade or time the market or even do any sort of research into individual companies, which I know is hard for most of you. You just need to invest your money in a low-cost S&P 500 index fund or ETF. There's some commissions there, and then you wait. Granted, you're waiting 40 years, but $450,000 when you're approaching the age many people retire, it seems a lot more valuable than the initial $10,000 investment you made when you were young and had your entire work life ahead of you to make money the regular way. So please, I'm begging you, think of it like this. A little money saved and passively invested in the stock market is the easiest way possible when you're young to turn into a massive fortune when you're old and have all sorts of additional costs and responsibilities. And all you have to do after you initially save that money is let it sit on the sidelines, ideally in a 401k plan or IRA, so that you don't have to pay capital gains or dividend taxes on your gains. The same logic applies if you're 30 or 40 or even 50, but you get a lot more bang for your buck if you start younger. Which brings me to the bottom line. Even if you don't have time to do homework, the stock market is still the best tool out there for growing your wealth, and thanks to the magic of compounding, the earlier in your life you start investing in the market, the bigger your long-term capital gains can be. And of course, it's not just capital gains, but also dividends. Everything gets reinvested. Let's go to Brenton in New Mexico. Brenton.
Jim Cramer, big booyah from the land of enchantment. How are you, sir?
I am good. How about you?
I'm doing fine, thank you. Hey, general question. Mutual funds and index funds claim minimizing single stock risk.
Right.
But inherently, though, isn't it fair to say that mutual funds and index funds have other risk that you would avoid with a single stock portfolio?
Absolutely. And I think that's why I always suggest that there be two portfolios. There should be that capital preservation and somewhat appreciation fund. That is going to be, we put that aside for retirement, and that should be in a diversified fund. I prefer to be an index fund. And the rest should be mad money. A sliver of it, though. Mad money, we pick individual stocks. That's why we call the show Mad Money. I don't want the bulk of your portfolio in individual stocks. There's too much single stock risk. But I want you to be able to pick stocks, and I know you want to do it or you wouldn't be watching the show. Brian in Oklahoma. Brian.
Thanks for having me. First time investor. How do you value one company versus another? Measure their value.
Well, we spent a lot of time in Get Rich Carefully talking about that. And what you're really trying to do is measure the future earning stream. And if you can measure the future earning stream, you can figure out what you'll pay for that earning stream now. And what really matters is that if you take a longer-term view, you can get a feel for what that stock might be able to give you for dividends and capital gains. Dividends tend to be for capital, preservation. And then the capital gains is for the appreciation stream. I want you to have a little bit of both. But you got to be thinking about what a company can earn in the future. That's what dictates stock prices. This show is about helping you build and preserve your wealth. And the stock market is the best tool out there to do that. A lot more Mad Money ahead, including the four-letter word of the investing world. What it is and why the conventional wisdom about it is all wrong. Plus, I'm not pulling any punches here. What you absolutely must not be doing in your retirement account. And I'm unveiling the rules you need to navigate in a bear market. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.